Welcome back to the Millennial Money Canada podcast. Today, you have myself, Sam, and Mohammed back on the pod. And the topic of today is TOSI, tax on split income. But before we dive into the topic, Sam and I attended our second annual Portfolio Strategies conference together, which is a conference that is put together by our investment dealer. It was my second. Sam, how many years have you been with PSC now?
5 years now. So this is my fourth conference. I went the first time in 2021.
Yeah.
Yeah.
What's your takeaway?
Well, we got some amazing vests. Right. One which if you guys are watching on YouTube, you can see Guillaume wearing. A little bit of, I don't know, is coercion the right word to say how you managed to get your hands on one of those things? But it was good nonetheless. No, it was a lot of fun. Like, I went through, like, the first day is always business building and practice building. So I was actually asked to be up on a panel on marketing and how to grow your business via marketing. And we got talking around centers of influences too. So talked about, our amazing accounting partners that we have and our tax and legal partners and our mortgage brokerage partners. And so kind of able to, to do what one advisor challenged me maybe 6 months ago is don't just give lip service to what you do, actually like implement it, right? Because sometimes it's easy to give lip service to things. So yeah, that was fun. And we had supper with some, like, every night we would go out for supper together, and there was a few of, like, the wholesalers there. So we got to meet some of them from different fund companies, and Guillaume was right at home. Hey, you're right at home, man. Like being a CFA and like hearing these CFAs talk about like long, short positions and futures and options trading and all of this stuff. I'm like sitting here like, can we just talk about like how beautiful Victoria is? And they're just like going in depth into fund positions. But yeah.
I mean, Sammy's mentioning it. The last night we went for dinner with, the head of the multi-strategy at one of the largest liquid alts or hedge funds, so to speak, in Canada, like
And we don't have any positions with these guys, just as a disclaimer. Like, we don't sell their product. We have access to it, but we literally have no one on our books with this product. So
no,
yeah.
but we had like a great dinner. And so, but my takeaway from the conference, so just for the listeners to understand, is you're basically sitting there, and yes, you're networking with other advisors, but you're basically sitting there and listening to like different investment strategies all day long. And I think my biggest takeaway is kind of three things. We already have like a very defined investment philosophy here at Millennial Wealth. But if you don't have, that's my first takeaway. If you don't have that, it's so easy to get lost into like the myths of investing, shooting from the hips type of strategies. Like, people are literally contradicting each other on stage, like one presentation after the other. Like it's so if you don't have something grounded in research and value based in terms of like what's aligned with you and what you believe, and based on on the statistics, it's really, really easy to just trust someone who might have not done a similar type of research. So I think that's my biggest takeaway. The second one is, sometimes in our world, we tend to be like in an echo chamber, I feel, where you tend to kind of read the same thing, follow the same people. And my takeaway from this thing is, there are a lot of tools out there, and it's just knowing when to apply them. And that's where that's where like most advisors, I think, fall short, is like they don't know where to apply it, or they believe that a certain tool is like the best thing since sliced bread for that specific case, and it's not. But really, when you take those tools like separately, like they all have some good and bad and trade-offs in a way, right? But the other thing that I think that sets us apart in terms of like geography or who we serve is every single person on stage, portfolio managers, head of research, presented things about lower volatility and income. That's what I noticed. I was like, because the average age in the room is about 55, 60, 65, 70 years old advisors. Yeah. And their clients, they're all retired. We have problems with some clients, not problems, but where they're like, Guillaume, I want more risk. Like, they don't care about downside volatility for the most part. Like, they don't want to see maybe 70% drawdown, but for the most part, they want to try to maximize. They're still saving and accumulating. They want to maximize their net worth, and they really want more risk, and they really don't care about income. So a lot of the things that are available out there are kind of like useless to us, because that's just not who we're actually working with. So anyway. It's just funny to
Yeah.
like hear that, right? They all talk about half the downside volatility, and I was like, dude, I never had a single client who came to me and wanted to have half the downside volatility, because if you're doing that, you're definitely capping the upside. So anyway, that's my takeaway. It's like,
Wait, so are you telling me there's no free lunch? You can't get lower volatility and higher returns? I'm kidding.
Well,
well,
it depends on who you ask.
yeah, you can get
It
the
depends on
same
who you ask.
return with less volatility, but you know,
Yeah.
yeah,
Yeah.
that's
Yeah. You got
that's
to
up
know
for
exactly
debate.
when to jump in and jump out of the markets too, which is always, something that people claim to be good at, right? And it is funny. Like, I have a lot of respect for those portfolio managers that sit up there, and like these are actually the people running the funds. Like, these aren't just like people trying to sell the funds to advisors. These are actually the portfolio managers who run the funds, and they're very convicted in their strategies. And I'm not the person to sit here and say you're wrong, right? Like, that's not my job, and that's not like I wouldn't be able to in a debate with them. I would get smoked. And so, but the one thing like I took away from that was the way that each of them are so highly convicted in their strategies. And what Guillaume said, and some of them contradict each other, not like within the same company, but like one company will come up and speak about their view on the macroeconomic conditions, then another company will come up and speak about it. And all of a sudden, it often contradicts, and one not often, but sometimes contradicts. And then it's like you have to know when to get in, when to get out, and all of these things. And I find that each manager will say, like, we try to avoid the bad stocks and try to, buy the good ones, right? And each of them has such high conviction on their good ones, but it's like you can't all be buying the same things, right? And so in my mind, it goes to, I think everyone is just so focused on, especially on the active management side, about trying to time the market, get in the right time, out at the right time, buy the right stocks at the right time. And I just, when we look at the aggregate of doing that, it does seem to be a zero-sum game, and sometimes even a negative-sum game when accounting for fees. And so, not to say like, these are strategies we would never use, but it did strike me kind of to what Guillaume was saying there too. But yeah, overall, it was a good learning experience. I learned about what, companies like McKinsey, what their global macroeconomic view is on the world in the next 12 months, and what some of the micro stuff back down in Canada, what we're expected to do. I think the biggest takeaway, the statistical takeaway for me, is that, and Mohammed, you probably see this a lot on clients' tax returns getting interest income, but there's an estimated $256 billion in GICs that are expected to be in motion, meaning it's not the total amount of GICs on balance on the banks. It's just the amount that's expected to move out of GICs. And that's a big number. And some of the portfolio managers were talking about where they think it's going to go, right? Like, is it going to go towards people seeking income? Is it going to go towards people seeking growth? But at the end of the day, like, I mean, we've seen clients recently have come in with GICs being half of their balance, right? Because the rates were so competitive 3 years ago, and maybe they didn't want to take as much risk then, but they're still 40s, 30s, and they do have a risk appetite. So where are we moving that money to, right? That's a conversation. But that one was fascinating, that there is actually that much in GICs in motion, because that's a big opportunity for advisors to make sure we're doing good planning and good risk planning for clients as well.
Yeah, and I would say that every single business owner that is starting to have some successes and having retained earnings, that every single ones that I've worked with, they've all had literally GICs or high interest savings account in their operating company, mostly because they didn't even know what to do with it. And they've never had a plan. And then they started to, oh, well, I need to have some buffer. But then after that, the extra, I don't really know what to do with it. But it's literally the number one and the biggest mistake that I think I see business owners making. With just cash in there for two reasons, right? One, it's a missed opportunity to observe compound wealth, which would allow them to, again, either retire earlier, achieve financial independence earlier, and then even save less throughout their career. And then, yeah, just making sure that it's like they're maximizing every dollar by far. And then when they touch on that on stage, I mean, it just echoes with what we're seeing on the ground, right?
Yeah.
And that's exactly what I'm seeing too. And I guess one of the other factors I see when people do these sort of alternative investments is, I used to work with a person, and they worked with a wealth manager, and they invested money with this portfolio manager who the investment advisor said was beating the market after fees. But then the portfolio managers kind of retired one year and the whole fund got liquidated and they had a huge taxable event and they don't usually pay that much tax, but that one year they paid quite a bit amount of tax just from
Mhm.
that. So I think managing the taxes also on those alternative investments is always a challenge just because of the risk that the portfolio manager might just leave one day.
Yeah. Yeah, that's a good point too. And like the way some of these, it was kind of funny because there were some real estate REITs presenting and talking about how 100% of their return to investors is return of capital. And then another real estate investor went, or a portfolio manager went up and said, "We don't pull any, fancy, tricky accounting to try to get you your capital back. These are straight returns." And I kind of laughed at that, right? Because it was literally just like one person saying, "These guys are just tricking you by giving you your own capital back," and then another one saying, like, "We actually give you real returns." But it's such a convoluted system out there, the accounting system, how this stuff works, and like how do you actually get return of capital out from an initial investment that's in illiquid real estate, like those types of things. And we're not going to venture down into that rabbit hole, but a lot of things that I'm sure, Guillaume probably has a better understanding of how this stuff works. Mohammed, just from an accounting perspective, I'm sure you kind of have a little bit of an understanding from the accounting perspective how these return of capital structures work. But yeah, it's sometimes it can be a mess, and sometimes the quest for low tax events can lead to like a messy portfolio that's not actually achieving what you wanted to achieve. So that's another consideration, right? There's so many that you have to take into account.
The last thing people need in their portfolio for the most part is more real estate. That's the last thing that they need to have exposure to, right? They usually have a primary residence, they already have a cottage, they
Yeah.
might already have an investment property. And the other thing too is if someone wants to invest in real estate, there is no shortage of option. It's not that you just need to buy a rental apartment, rental condo and rent it out. That's one option.
Mhm.
But there's about 5 different options that we sat through, that you can buy units of, again, different REITs. And there's so many different strategies and portions of the markets that they're playing into, whether it's like old rental that are renovating, whether it's building brand new constructions, like that guy who was building like, projects of like
Luxury
40, 50,
homes.
50
Yeah.
houses at
Yeah.
a time, like just in new developments. And so I mean there's no shortage of real estate exposure if that's what someone wants. Like anyway, that's
Yeah.
another takeaway. Yeah.
Yeah.
Are we
Cool.
moving into the episode?
Let's do it.
All right. Tax on speculative income. Mo, we're gonna turn it over to you, but do you want to give maybe a little bit of background, like why is TOSI like such a big deal? I mean, first of all, like what is it? Why it becomes such a big deal? And what was it like pre-TOSI and after
Yeah,
TOSI?
so that's a great question. There was a lot of butterflies in the air. Things were great. People were loving life, paying very little taxes. Several years ago, basically, there's two ways you can pay yourself from the corporation, right? You can pay yourself a salary or you can pay yourself a dividend. And CRA kind of always had this requirement that if you're going to pay yourself a salary, unless you're the primary owner, then it has to be reasonable. So if you were going to pay family members a salary, it only can be reasonable based on the work they do. But dividends, they never had any rules of reasonability for dividends. So people used to make, their spouse, their children, different family members, all shareholders of their corporation. And they used to pay them dividends, even when they were under 18. And then I think it's around the 2006 year, they started saying, you know what, we're going to apply kiddie tax, which is basically we're going to tax if you pay dividends to your kids who are under 18, we're going to tax them at the highest rates. And so people were very upset, but there were still some benefits. If their kids turned 18, if they have a spouse, they could still pay dividends to those people and they can use up their low tax rates rather than paying them the dividends at the very high tax rates. So it was still very beneficial. And then 2017 or 2018, I can't remember now, came along and then they said, okay, this is getting a little out of hand. We're also going to shut this down and we're going to only let you pay dividends to people who are 18 plus, family members who are 18 plus, if they meet certain requirements or exceptions. Otherwise, they'll also be taxed at the highest rate on those dividends. So you could still pay them dividends. They're just going to be taxed at the highest rate on those dividends. And those are the TOSI rules. And a lot of attention now, a lot of the time we spend with clients is navigating exceptions and seeing if they qualify for any of these exceptions, because the benefits could be very big if they do.
Yeah, I wonder why they all decided like, hey, we're gonna we're gonna like include more of your dividends as at a higher marginal tax rate. It's looking, and this is like a personal thing, probably my perspective. It's looking at like, okay, well, where did government spending go from like 2015 to 2024, really? And it's like there was a plan to increase government spending, right? Now it's called government investment versus government spending, but it's all government spending, right? Like, where are they going to get those revenues from? Well, it's tax revenues or borrowing, right? And so, like, if you borrow to fund your deficits, you could cause inflation. But now, if you increase tax, right, then especially they're only increasing tax on like a subset of the population, not like the entire population, right? Goes to fund quite a bit of excess revenues. And we kind of see that in the way the spending ticked up from the government over the past 12 years or so. So it's interesting hearing about that. I am curious. I haven't looked at the numbers as to like how much actual additional revenue they've generated from this. Because I'm sure a lot of people just decided not to pay extra money to their spouse, right? And just live off of what they need through dividends. So maybe they deferred a lot of it. So maybe it hasn't actually ticked up in a lot of extra revenue, but I'm sure it has.
Exactly. I
So,
think
yeah.
that's the challenge with tax policy. I think, it's not always clear what's going to happen. There's always repercussions. So what a lot of people doing are just spending less personally, keeping more in the corporation, and then the corporation gets inflated with a lot more retained earnings. Sorry, Guy, were you
Mhm.
going to say something?
A question about the corporate structure when you have like pre-TOSI or after TOSI, when you have, let's say, a spouse and back in the day, kids, I guess. So you would have one class of shares for the owner or the primary shareholder, and then you would have a second class of share for, let's say, the spouse and the kids. Was that a typical structure that you've seen, or are there other like recommended structures that you usually tend to see?
Yeah, those usually you'll have multiple share classes, and you probably want to have uh each person you might want to have their own share class, because you never know what's going to happen for one person's income for that year. So just so you can pay different dividends on different classes, right, without having to share all the dividends on one class, you might have one person assigned to kind of one share class. So that you can pay dividends on one share class,
Mhm.
but not the other share class, and you don't have to kind of share in pro rata for that dividend.
Yeah. Interesting. Just a question here. There was also, I believe, a change on passive income in a corporation in that same time frame. So, like, I'm kind of going back to my example of like, well, maybe people deferred into their corp. Didn't the tax rates increase for passive income in the corps over the last 10 years as well? So, like, I think they probably thought that through and said, well, if you're going to defer, you're going to pay more tax on your investment income.
Exactly. Yeah, to an extent, they did. They did kind of foresee that. They
Well, those
noticed.
guys are
They
smart.
noticed, I guess.
uh,
They noticed. I think there was a big talk at that time about tax fairness and how the wealthy are not paying their fair share of tax. And I guess they kind of assumed that the wealthy were business owners, which presumably they are. And so they said they're using their corporations as a retirement vehicle, which I guess they are, but that's kind of how the rules were made out of. So they just disincentivized it a little more, but it's still very beneficial. And especially
mhm.
in Ontario, where there's kind of like the province didn't necessarily conform with that passive income grind rule. So you have kind of like a loophole in Ontario in that
You
regard.
Talk
have
more
a
about that
really
in a later episode, but yeah.
you have a beautiful graph that we're also going to include in the newsletter. If you're not subscribed to the newsletter, make sure you subscribe, as we usually send out like a summary of the episode. I want to just touch on the graph that you've put out on social media around the 4 ways that you can pay dividends to family members. Do you want to start with, so number one, it's like there's working in the business. So what are the tests there that would qualify someone to receive a dividend?
Yeah, so this visual, I think it goes over 4 general ways to pay that you'll be able to pay dividends to family members. But within those 4 general categories, there's subcategories that are very specific in how to exactly meet that requirement. So with paying yourself a dividend, I think to the first one to start with is that just like you can pay a reasonable salary based on work performed, you can actually pay a reasonable dividend instead, right? Or you can do a mix as long as the combined amount for both is reasonable, right? So that's important. Generally later in someone's business career, as they start to earn a lot more investment income, because as you earn a lot more investment income, paying dividends could be more advantageous than paying salary. So if you have a family member working in the business, uh, as long as they're 25 plus, If they're working just 5 hours a week or something, you can pay them a reasonable dividend.
How do you qualify reasonable?
Yeah, so that's always a challenge. They look at different things like, your contributions to the business, the tasks, things like that. How much you would pay a third party to do the same amount or hire a third party to do the same amount. These are kind of the tests that they look for.
So if my wife does bookkeeping, I can't pay her $200,000. That's all she does for 20 hours a week. Is that kind of unreasonable, you think?
Well, if a bookkeeping firm is charging that much, then go ahead. But if not, the Siri actually uses an example where someone's paying, $1,000 or something a month for bookkeeping, and they want to fire that bookkeeper and hire their spouse as a bookkeeper. And they say essentially you can pay a similar amount to what you were paying that bookkeeping firm.
Interesting.
What about the second part about investing in a company?
Yeah,
Do
so
wanna talk
you
about that?
could. Yeah, so that's kind of in for number two. Number two, you could invest in a company. That's another way you can pay dividend. If they invest in your company, that's another way you can pay them dividends. And there's kind of two different categories depending on the age. If they're 18 to 24, then you can pay them the prescribed rate, which is a rate set by the CRA, every quarter on their investment. So, if let's say you had like a child who's 18 years old, they have $100,000 and they invest in your business. The prescribed rate right now is 3%. You can pay them about $3,000 a year in dividends, just like you would kind of pay them as interest, but you can just pay them in dividends, which may be a bit more tax advantageous for the child, depending on what's going on with their situation.
So that's like between ages 18 and 24. So there's a 6-year period where the maximum you can give them is prescribed rate on the amount of their investment. So if like they invest $100,000 and the prescribed rate is 4%, I could give them $4,000 per year, essentially.
Yeah, exactly. I see this commonly with, sometimes people do some income splitting and their child has received the money and they're worried about their child spending the money. So then they kind of maybe incentivize their 18-year-old child to kind of invest for a fixed period of time in the company so that they don't have all that money just where they can spend it.
Damn, I'd love to be a parent and pitching my company to my child as a good investment. And if you don't, no more vacation for you. You're staying home.
Yeah, you're staying home.
Yeah. Okay, so number one was working in a business. Number two was if you're investing in the business. And then number three on your graph, you said hitting certain milestones.
Yeah, so I think there's certain milestones that when you hit, you could potentially pay people, family members a dividend, right? So if you turn 65 or you're 65 and older, you can pay dividends to your spouse or your partner, right? And there's no limit to how much you can pay. You can pay them all the dividends and you can take nothing. You can pay it 50-50. So whatever is kind of best for your situation. If you sell your business and you have a whole bunch of retained earnings in your company, like a whole bunch of profits left over in your company after the sale of your business, you can pay that to people who are 18 plus, like family members who are 18 plus, and there's no restrictions on that, right? If you retire, and you're no longer doing the business that you were originally doing, right? Then you can also pay dividends to family members who are 18 plus without restrictions.
So would that be like a holding company essentially, where there's no active business income? You can just
Exactly. Like, so sometimes when you're selling a company, you might have holding companies sell part of the shares of the business. And when that happens, the holding company can now kind of pay dividends to the family members. Or same thing when you retire.
So I'm sure the CRA has thought of this, but like, okay, so you set up a holding company that owns the shares of the operating company, you pay an intercorporate dividend to the holding company. Obviously, there's no tax implications on that. But then the holding company is set up so that there's the primary owner, let's say it's, one of the partners of the initial operating company, and then their spouse is also set up on the holding company. So dividends from that holding company, even though they're not direct shareholders of the operating company, but the holdco is, would essentially, that would flow through, right? Like that TOSI rule would flow through on the holding company. Is that correct?
Yeah, I would. Yeah.
Okay. So that's good to know, because sometimes people think that they can just like set up another corporation and be once removed from the operating company and then like bypass those rules. But I'm sure that was probably the first thing they thought of when they set these rules up, and basically just like, no, you can't do that.
So there is one exception, and that's kind of in number 4. And there's some technical rules that if you can qualify under these rules, then you could potentially split income. And under one of those like technical rules, one of them was an opinion the CRA gave, and it's basically, let's say you've made, $100,000, you pay that up to the holding company, and now the holding company invests that money. That money is considered something called second generation income, which is, so it's not the original 100,000, but any new income that's being generated, that's the second generation. CRA gave a view that as long as you're not carrying on an investment business, then that second generation money can be paid to, people who are 18 plus. Now, so people love this rule, but I think the issue here is sometimes CRA says things that may not necessarily agree with how courts have interpreted rules. And yeah, in fact, what the courts have ruled in the past is anytime you have a income in a corporation, that's considered a business. So it might not be considered business income, but it's considered a business. And so that kind of insinuates that even second generation income would be considered, investment business. And so you wouldn't be able to do that based on court rulings. But if you're kind of relying on CRA's good grace, then maybe it's possible.
So just to clarify on that, so you've $100,000, you've invested it in the holding company. You earn, just as easy example's sake, a $10,000 eligible dividend. And so the way I'm assuming it's tracked on second generation income is paid out of the notional accounts, right? So you'd get like would it be a $10,000 credit or a $3,800 credit to the ERDTOH account?
Yeah,
$3,800 credit to the ERDTOH account. And then you could basically say, okay, I'm going to now pay out my notional account balances to the non-active spouse. And the corporation receives that $3,800 refund. You pay out the $10,000 dividend to the non-active spouse. So like maybe I'm messing things up here, but essentially they use the notional accounts to track the second generation income. And the only amount that's eligible to be split would be a factor of those notional accounts, correct?
Yeah, that's a great way of looking at it. They actually don't say use the notional accounts. They actually just say you have to kind of segregate it in some sort of way. But that would actually be a great idea, like that they haven't mentioned, but it'd actually be a great idea to kind of figure out how much the second generation income would be. But again, there is risk with this because the courts may not necessarily agree with what the CRA has signed off on, right?
Great.
But
I'll write them a strongly worded letter.
Would any income generated from within the holding company be classified as second gen income, essentially, like just by nature of it?
Yeah, that's a good way to look at it, right? So any sort of investments that they make or anything would be second generation income.
Okay. That's interesting. I see others. I mean, we don't really have too much cross-border situation. I mean, Sam, maybe you have. I've never marketed myself as a cross-border specialist. And we don't have a dual license. I think this is just not the clientele we kind of tend to deal with. But you do have one technicality around this. Do you want to talk about it? If the family member is not a resident of Canada?
Yeah, so a lot of people might have like immigrants or thing like that. They might have family who's not in who are not in Canada. So they might, have parents back in the US or Portugal or wherever the case is. And one of the interesting things is that TOSI doesn't apply to dividends to someone who's not a resident in Canada. So you can pay them like unlimited amount again without TOSI applying. Now there is going to be withholding tax on those dividends, and they might have to pay tax in their jurisdiction on those dividends. But if that tax isn't as much as tax paying yourself, and you usually kind of maybe pay them a monthly amount just to kind of help them with their living costs, then it could be beneficial. Now, there is some GAR concerns here. CRA hasn't said anything. This is a clear, carve out in the rules. But again, it's just something to be mindful of.
Okay, so how does this apply to shareholders that are corporations, like a non-resident corporate shareholder? So let's say, for example, I set up a corporation in, I don't know, the Cayman Islands or Bermuda or something like that, and it's a shareholder of my business, and I decide to pay that entity like the dividends and then reroute it back into Canada. Like how would that work? Or
Yeah,
even
so
just leave it in the held away corporation.
there are rules that tax you based on if you have a foreign corporation and earns investment income. There are rules that will tax you in Canada based on that. Like they don't want you kind of to get away from taxes by setting up foreign corporations. So they'll look through your corporation and you'll have to pay tax on that income. So that won't work for you. But if you legitimately have a person there who you want, who may have helped in your business or a family member or something like that, then it could be possible. But again, there's business risks with making someone random who's not involved in your business as a shareholder. So
Of
that's
course.
something to be mindful of.
Yeah, the reason I asked is because we have a lot of people who are kind of entering in that high net worth stage of life, and they hear things on YouTube about how setting up, non-resident corporations can help save in taxes, right? And those types of things. And I was curious if that was one of the ways where, it could potentially be done. But essentially, from my understanding, then on session 4, it has to be an individual, it cannot be a corporation. Is that correct?
Yeah, exactly.
Okay. Thanks for the clarification.
And I think just to run through, there are some things that, like working in the business, if you work at least an average of 20 hours a week on a regular, continuous, and substantial business, or you have for 5 years in the past, then there's unlimited dividends you can pay to that family member, right? So just as an example, if you have a partner who's worked in the business for 5 years, working 20 hours a week plus, and they stop working in the business, you can keep paying them dividends for the existence of that business without, even if they stop working in the business after those 5 years.
Interesting. So the back to number 3 for a second, the option for your spouse or partner 65 years or older, that just falls under senior incomes. Senior income splitting rules. Is that correct? So basically, like, it doesn't matter where the money's coming from. It's coming from my RSP. If it's coming from, investment income, if it's coming from my corporation, realistically, I could split my income with my partner at 65 when they're 65, right?
Well, it was
Is
meant
that
to
the same
mimic
thing?
those rules. Yeah, it was meant to
mimic it?
mimic those
Okay.
rules. Yeah, but I guess if you're earning it personally, then you can't just split that income. But if if it's a pension or it's from a corporation, you have kind of that ability to kind of designate a
Right.
split.
Right.
All right. Well, just to summarize the 4, I guess it was first one was working in the business. Second was when you're investing in the business. Third was when you're hitting certain milestones. And then fourth was technical eligibility, which you covered a few here. And those were kind of the 4 ways that you can pay dividends.
Yeah. And if you
To
haven't watched our
shareholders.
last
Yeah.
episode, we go through some corporate structure and income. We kind of touch on income splitting, but basically what we're trying to avoid here is when we do shift income to another person who's a shareholder of the business, avoiding them getting taxed at, in Ontario, it'll be 53 and change percent on the income we split with them. Obviously, it's more beneficial if, with my wife and I, if she's actively working in the business, if like I make, let's say if we're paying ourselves 200,000 in total, versus instead of me making 200,000, it'd be more beneficial if I made 100 and she made 100. But the CRA has kind of stepped in and said, like, you're not going to be able to do that unless you can actually test. And I'm talking dividend income here, like unless you can actually test that, the spouse was working to qualify for that $100,000. And then I think this is really helpful to go through some of those technical exceptions and just how to actually successfully avoid TOSI legally. And I know there's obviously gray areas, and I think we touch on more than anyone else I've ever heard on tax risk tolerance here. Like, you have to know like what may come back. And I think any accountant who advises on strategies like this, I'm sure you guys included, have like a waiver of liability form that you sign saying like, hey, we're going to do this for you. But like, you have to understand the risks here and kind of the informed consent kind of thing. Like, hey, we're going to do this, but the risk kind of lies on you if the CRA audits you. and says you can't do this, and you have to just know, are you okay with this or not? Do you want to take that much risk or not, right? And at the end of the day, it's based on, if there's a 80% chance that it's going to go through fine and a 20% chance that the CRA is going to come back and audit you and say no, and you're like, I don't care, like, we're going to take that chance, right? Great, do it. It depends on how high your risk tolerance is. It depends on what stage of the business that you're in too. I think too, if you're looking at like, hey, I might sell my business in a year, you probably don't want to take a lot of tax risk with your business and end up like in a whole mire of CRA like audits and all that stuff when you're trying to sell your business in a year, I would imagine. But yeah, just know where the state of your business is at, know what you're comfortable with from a risk perspective, work with good accountants that understand tax risk and all those types of things, and go from there.
Well said.
Mo, question for you. What what are the common, I would say, initial questions when people wants to engage with you, like around this topic, or do they engage with you around the topic of dividends in general, and then you educate them on TOSI, or like, how is that playing out like within your practice and the advice that you're giving on a day-to-day basis?
Yeah, I see two batches of people. One who have no knowledge of these rules, and they might, have one share class, and they're paying dividends on that one share class, even though their spouse might not be involved in the business, and so they have no idea about this. And then the second batch of people is really people who are so, like, I guess they've been advised by their accountant that there's no income splitting possible. But one of the technical exemptions here is if you don't have a service-based business, you may actually be able to kind of pay dividends, and they might not have a service business, right? And so they think there's no way to pay dividends no matter what, and they're not aware they haven't really done a deep dive on the exception. So really depends on, there's two things. Number one, tax risk and their situation. And then number two is knowledge. It's hard to communicate a lot of these things, especially the technical exemptions. And so if I think if the exceptions are not technical, then, we can walk them through we can explain some of the restrictions and walk them through some of those ones. The technical ones, sometimes I feel like it's just better if we don't bring it up, especially depending on their tax risk tolerance, right? So I think it depends on the client, and it depends on their knowledge, and it depends on their tax risk.
So follow up to that. So like in the investment world, there's two types of portfolio management. One's discretionary, one's non-discretionary, right? So both of us, like, we're non-discretionary. But let's say we have a 60-year-old client who doesn't really know anything about the markets and just trusts us to manage their money for them. On the non-discretionary side, we have to explain the portfolio management side, like what are we actually doing? Like how do we determine, the right types of investments to go in, and they get them to sign off or give verbal consent to any changes we make to their portfolio. The discretionary side, however, that same 60-year-old who has still no knowledge of investment markets could have their portfolio managed with a portfolio manager who basically just makes the decision on the client's behalf and doesn't get them to sign over every move, over every rebalance, over every change in position. And so like, regardless, really, and I'm not saying that there are rules in terms of like client investment knowledge, but like if both clients have the same level of knowledge, you could still potentially be discretionary on one side and non-discretionary working with the same client or same type of client. How does that work in the investment world? Is there a world where client who doesn't really know anything about taxes just says, Mohammed, you do whatever you think is right, and I'll just sign the papers? Or do people do that? And if they say that, are you like, no, we're not going to do that for you? Are there some accountants who do? Like, how does that work? Is there like a different model?
Yeah, there's actually a really big tax case on this. There's a really successful business guy, and he just trusted his accountant 100%, and he took out a bunch of money from his corporation. It was never reported on his personal return. And the CRA came back to him 10 years later, and they're like, you owe all this tax. And he's like, yeah, you're right. I do owe all this tax, but it's been more than 3 years, and you can't come back to me after 3 years. And then they said, wait, there's a little exception here. It says here, if you're grossly negligent or there's misrepresentation, then we can go back more than the 3 years. And the case centered around, was he grossly negligent? And they said someone who's prudent, a prudent business owner, should review his taxes. And so what I in situations where someone does kind of trust us a lot, we still try to educate them. We still try to give them a little bit of that background, just so that, that 3-year cutoff can can actually apply. And then the second thing is we will take less or like no tax risk with them if they completely trust us, because we don't understand what their tax risk tolerance is. We don't know what their appetite is. And so we're only going to do things where there's no subjectivity and it's purely, allowed.
That's interesting to me because our tax code is becoming so increasingly complex. And I think, as someone looking, even like someone educated, like even, people in the financial industry, we're looking at tax returns and we're like, well, I think I understand some of this, but not all of it, right? Like it is interesting to me as tax code becomes increasingly more complex, how they're still applying, this level of onus back to the taxpayer to say, like, you've still got to understand what's going on. Um, like,
Yeah.
how do you raise complexity without kind of giving a little bit more grace for that?
Yeah, I think what they're saying is that there's some aspects that, someone is generally expected to know, where and there's some aspects that they're not expected to know, right? And so, depending on how complicated it is, then sometimes you can just rely on the taxpayer, and then sometimes you can't just on the tax preparer, and then sometimes you can't just rely on the tax preparer, and you wouldn't be necessarily grossly negligent if you didn't catch a very complicated tax issue that no reasonable person can kind of see.
Does that also go back to you vetting this specific accountant? Like so for example, if I'm getting my taxes filed by someone who's not a CPA, who, does this part-time, but they're telling me like, hey, I really know what I'm doing. I've studied this stuff for years. I used to work at one of the big four. I just dropped my licenses. Like, how does that come back on the taxpayer through some of these more complicated transactions? Because I've definitely seen it where business making over $1 million in revenue is not working with a CPA, is really just kind of working with a friend from college or their parents' tax preparer or something like that.
Yeah, I think that is also like that's something to look at, grossly negligent. So if it is a complicated topic, for instance, and you wouldn't expect someone who's not knowledgeable in tax to know, then maybe the courts would look at what's the vetting process you went to choose an accountant, and how much due diligence do you do on your tax return? How much was this kind of like how much are you investing in tax services? Is it a reasonable amount, or is it something just to get it done without relying on or assuring its accuracy can be accurate based on how much you're paying? So, I think they do the courts. They are generally fair. I like to think, and they do look at these factors, and they do understand the different kind of levels of expertise that exist, and so that's how I think they would approach that specific situation.
Interesting.
Yeah. That's a fascinating crossover, Sam, between the investment and the accounting world. I can tell you, like, just like wrapping up from the conference, there is one presentation from a Liquidol, like again, north of $10 billion asset manager in Toronto. And I can tell you their presentation was like flawless in terms of like the nuances and the technicalities that they were using. And again, all CFAs on stage. And I guarantee you in the room, I bet you the knowledge was glossing over 95% of people. And you had to be extremely attentive to pick up on the things that they were kind of like sharing in a way, which I thought was very, very subtle. And the other takeaway was that I strongly believe that many, even advisors, have no clue how their clients' money is invested. Like maybe at a high level, like they read the prospectus and whatnot, but like to deeply understand what's going down, like, in terms of implementation, I think, let alone the clients, I think the clients have zero clue. And then the advisor, maybe have a bit more clue than the client. But I still think like advisors have a long way to go, especially when you talk about those more esoteric strategies and complex strategies. I just found it like fascinating. Yeah, how
Don't
it's
don't
playing out.
advisors have like I think it's know your product or KYP requirements?
So you're supposed to, no, you're supposed to know. But I mean, there's some of this stuff, man, it's like pretty complex. And like, it's not like you need to understand it, like maybe all the intricacies, like you need to understand maybe like of course the risks and then how it's applicable to a specific situation, but you just need to understand at a high level to be able to sell it really. That's where, and then you just be a
Yeah.
good salesman. But
Basically, it goes down
I
to
just find it interesting, yeah, that everyone really with a basic license can sell like some pretty complex stuff, man. And we use like super simple stuff, and we can understand. I can tell you like a lot more complex strategies, but there come some trade-offs, and sometimes they may not add the value that they're actually providing or promoting,
claiming to
right?
add. Yeah.
Or claiming to add, exactly. And that's why you need to have kind of the expertise to be able to differentiate what's really truly a value add, what's more of a, gimmicks or like, kind of sales pitch, and then what's kind of in a way detrimental to like maybe a
Yeah.
client's outcome because it just might not be a good fit, right? Or how the
see.
or how the product is structured in the first place. Sometimes there's some
And
things that are like they're not that great. That's from the get go. Yeah.
Yeah, and the KYP is honestly more of a fund to compare on fees than it is know your product. So, like for example, if we're selling a high fee active mutual fund, which we don't do, but like if we were to do that, we would have to give justification why we chose a large cap value or a large cap US growth fund with an active fee of like 80 basis points or 100 basis points over the S&P 500. Like, what was our rationale for doing that, right? It's really trying to get the objective of it is to try to get clients into the lowest possible cost products that actually still meet their objectives. And so portfolio managers now have shifted to just sharing their alpha stories. How much over and above the expected return, the standard benchmark did we earn for the fee that we're charging?
Good for risk.
Adjusted for risk, yeah. And so, yeah, sorry, but like that's
don't
what
say
they
something
shifted.
wrong to a CFA. He will correct you.
Oh, yeah, but that's kind of the shift in stories that we're hearing now that KYP is here. Is like yes, you do need to know that you're investing your clients in large cap US growth, right? But you then need to look at the alternatives out there and say like, well, why am I choosing fund A from this big bank versus fund B from this, an ETF from like a Vanguard or a BlackRock, which charges, 0.09 basis points or something like that, or 9 basis points instead of like 80 basis points. You have to come up with a justification for that. So it's not really about knowing the intricacies of the product. It's just knowing the comparables and what else is out there. Yeah.
And the comparable, I mean, I've been told again, the bar is really low when you talk about KYP. Like, and again, it's hard to standardize this, right? You're not going to start to, really go in depth with every advisor to know how much they understand. And again, the goal is to like help clients meet their objectives and all that stuff. But the reality is like there's more and more strategies and products out there than kind of ever before, right? And they're getting more sophisticated and more creative and whatnot. But I was told, I was like, Guillaume, what I'm expecting you to do is to know which, and I'm not kidding you, which fund quartile are the investments that you're recommending. Like, are you in the fourth quartile, third, So it's like, if that's the minimum, like, man, that's like pretty low. Like,
That's
you
a
just need to
low.
know, like, and then I wanted to like share the research where like, well, there's no predictability that a fourth quartile fund or top performer will continue to outperform, but like, I didn't want to like kind of open a can of worms here, but so I say, sure. I only offer 4 quartile funds, but like that's the requirement. And I mean, look, like that's like, that's super basic. You know what I mean? Like it doesn't really tell you anything about like, again, the complexity of the products that you might be putting your client's money into, right? Anyway, I think we're digressing here, but no, this is fascinating stuff. A good parallel between tax and investment. So any last comment, guys, for the episode before we wrap it up?
Beware of GAR. So there's always these anti-abuse rules that you always have to be mindful of, and you need to consider whenever you're thinking of any kind of tax savings plan, especially with TOSI. And also, make sure you know your product. I'm learning a lot from you guys on the investment side, so it's interesting to learn that. Sometimes I hear about an investment strategy and like something as simple as like a long short, or something like that, and I might not know the intricacies, but from what you're telling me, a lot of advisors may actually not know the intricacies. So I guess make sure you actually know what you're investing in.
Yeah. I'll tell you that conversation we had at supper with those alternative asset managers. Yeah, like I said, Guillaume was right at home there because they were like drilling deep into some like in-depth portfolio management styles and techniques. And at the end of the day, I don't think advisors need to know every single thing that happens in a portfolio. but they need to know generally how it impacts, the potential well-being and outcomes of the returns, what you're sacrificing versus what you're getting. There's always trade-offs. And that's the one thing, as we get more into product, the one thing we're learning a lot more of is like you said earlier, Mo, there's no free lunch here. If there's increasing complexity, that usually means there's increasing fees. If there's increasing fees, that usually means there's a higher hurdle for portfolio managers to hit to actually outperform or give risk-adjusted alpha, which is the risk-adjusted outperformance of a benchmark. And so, yeah, it's we're not saying that every financial advisor should be a CFA, because if they were, like, I would be kicked out of the industry. But there does need to be a level of understanding on the product side, and maybe don't take the fund objective at its face value. You do have to dig a little bit deeper, right? Where it says this objective is to provide lower risk with similar returns to like a regular portfolio, but like, okay, we'll dig deeper. How are they doing it? What's the trade-off? Why is it lower volatility? Is it actually, met its return expectations? You have to dig deeper into versus just like the fund facts or the prospectus or something like that.
Well, sir, we should definitely have more episodes on this. This is those are topics close to our hearts. But anyhow, thank you for listening. As usual, you're gonna have the link in the show notes. Copilot Tax. If you want to engage with them around, any tax question that you may have and you want to engage your services, you also can access or reach out to us, mwadvisors.ca. And with that being said, we'll see you in the next episode. Thank you for listening.